Over the past decade, private credit has become one of the fastest-growing forces in global finance. As banks pulled back after the financial crisis, private lenders stepped in offering companies capital while delivering strong yields to investors. But in 2026, the story is beginning to change. After years of rapid expansion, the private credit industry is facing its first real full-cycle stress test. While the sector remains large, estimated between $1.8 trillion and $3 trillion globally, new pressures are emerging that investors can no longer ignore. One major risk is sector concentration. In the United States and Europe, many private credit portfolios are heavily exposed to the software industry, with allocations ranging from roughly 20% to 40%. For years, software companies, especially SaaS businesses, were considered ideal borrowers because of their predictable subscription revenue. But the rapid rise of artificial intelligence is beginning to disrupt parts of that sector. Some companies are facing uncertain earnings prospects as AI reshapes business models and competitive dynamics. As a result, lenders are starting to mark down loans, distressed debt is increasing, and concerns about future defaults are growing. According to estimates from UBS, in a severe AI disruption scenario, default rates in U.S. private credit could rise to between 13% and 15%. Far higher than expected levels in leveraged loans or high-yield bonds. At the same time, investors are starting to pull money out of certain funds. Several large private credit managers have already imposed limits on redemptions in non-traded and evergreen vehicles. Blackstone's BCRED fund saw withdrawal requests close to 8% of assets. Blue Owl has restricted liquidity. BlackRock capped outflows from its HPS fund, and Morgan Stanley limited withdrawals after requests exceeded 10%. These actions highlight a core structural challenge in private credit: liquidity mismatches. The loans themselves are long-term and illiquid, but some investors still expect periodic access to their capital. Meanwhile, broader credit conditions are becoming more difficult. Inflation remains sticky, labor markets are softening, and the economic cycle is maturing. Payment-in-kind loans are becoming more common, covenant protections have weakened, and restructuring activity is slowly increasing. Europe is already seeing a rise in credit stress events, even though headline default rates remain around 2%. Additional risks include geopolitical shocks and the large wave of corporate debt that will need refinancing through 2028. However, not every region is experiencing the same level of pressure. Asia-Pacific remains a relative bright spot for private credit. Assets under management in the region are expected to grow from about $59 billion in 2024 to roughly $92 billion by 2027, an annual growth rate of around 16%. This growth is supported by a massive infrastructure funding gap, strong demand for alternative financing, and fund structures that are typically closed-ended, reducing the risk of sudden redemption runs. Defaults in Asian high-yield markets also remain relatively low, currently below 1%. Still, challenges remain. High-quality deals can be difficult to source, banks still dominate lending in many markets, and legal enforcement can be slow in some jurisdictions. The private credit boom is not over, but the easy phase may be. For investors, the next few years will require stronger discipline, careful underwriting, and greater attention to liquidity risks. Because 2026 may mark the moment when private credit finally faces its first true test in a full economic cycle.